CPI data comes and goes in the US, and the markets seem to like it. So where are we going now? That's the question we're going to ask ourselves here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we are going to take a look at what this CPI data did and try to focus on unpicking the details in this data to try to surmise what the market reaction here to these numbers is actually telling us. Because clearly here, the markets on the stock side liked it, but that only tells us a very small bit in the story. Now we have to go and unpick what some of these other markets did, because indeed we get a very interesting perspective here for the cross-market reaction that starts to explain a little bit more about how this is likely to evolve and what message these numbers are giving us here. So we're going to take a look here first and foremost at what were the numbers that came out, what were the contributions that the CPI data told us came from which part of the structure and what that means, but really most importantly, what the price action response was telling us. So let's begin here with the market reaction. As we said here, it looked like it was relatively supportive when we consider what's going on here with stocks. This is the S&P 500 here, just as a bellwether for overall risk sentiment. And we can see here, not only have we posted a rally, and that, of course, tells us the story already, but we very tellingly broke back through this key level of former support become resistance at the bottom of the range that was in place from late November into December, where we set up this high from which, of course, we launched a very concerted sell-off. This was the consolidation. Right here was where the sell-off got kicked off. We have now retaken that critical barrier here. And anything below it still looked like a correction within this overall decline. Well, now we look like perhaps there is a pathway from here higher back towards 6,000 and back to test these highs. So not only did the markets generally rally on the day, and did so in the wake of the CPI data. They took about an hour to digest the CPI data, then rallied. But they did this through critically important and sort of obvious with the naked eye barriers in the price action. And that seems to belie a level of conviction. Likewise, of interest, of course, is that with these numbers, the U.S. dollar weakened. We can see the dollar started the week on strong footing. This is the DXY dollar index. It's a bit of a skewed basket because of all the legacy currencies in it that have since become the euro. But nevertheless, it does give you some sense of kind of an average trajectory for the dollar against its major counterparts. It ultimately sustained the most damage against risk-on currencies like the Aussie, which of course makes sense in a kind of stocks environment that we just saw. The euro didn't do as well, the yen didn't do as well, but certainly the overall direction for the dollar here was lower off this former support become resistance right there. And gold prices very tellingly held on to their range support. As the dollar rallied yesterday, gold sold off into this range right here. And whereas the dollar held back from rallying through its relevant near-term barrier, so did gold, but on the other side. It managed to hold up without selling off through its major support here and held right there. So what was it in the CPI data that did this? Well, looking at the numbers, the headline came in a little bit softer than expected, 2.3% versus 2.4% expected. The core in line with expectations and unchanged from the prior month, 2.8%. Now, it's important to consider what these reference points are here. 2.8% is actually the lowest core inflation that we have seen in 4 years. The last time we were below that was March of 2021. So exactly 4 years in March, and the April number here was unchanged from that. The headline is actually the lowest since February of 2021, when inflation was just 1.7% year on year. So this 2.3, a welcome improvement, needless to say, but only modestly so relative to expectations. If we look at the internals here, what we find is that the main contributor, not surprisingly, still services, but also that services inflation continues to cool significantly. And to the extent that a lot of this other stuff amounts to a rounding error, this right here is getting some welcome proximity to the Fed's 2% inflation goal. Indeed, at 2.18 percentage points, this is actually the smallest service sector contribution to overall inflation since November of 2021, when it was exactly at 2%. So we seem to be looking at some welcome progress in the Fed's direction. Moreover, goods inflation, although it's flipped to positive from negative, we can see in March, goods were actually a disinflationary force here, but for the overall number, deflationary for goods. And now we've kind of flipped back into positive territory. There's not much of a difference in terms of the contributions from food and energy. Similar uplift from food March to April, similar downshift for energy for the same period. But if we look at the actual changes here, clearly the real action is happening here and here. And what seems to be the key takeaway is that the part of the economy where there is the most pull from demand, you can clearly see where the demand is because we can clearly see that inflation is in services. It isn't in goods. Now, the reason this is here and the reason that this wedge from goods inflation basically gets unwound as we work our way through 2021 and 2022 is what the Fed was saying back then about the transitory effects of COVID disruptions on inflation. Broken supply chains made goods more expensive. As those supply chains mended, that goods inflation got squeezed out of the equation. And what got left was sticky services inflation, mainly driven by domestic demand, including, of course, in the calculus here, the incredible burst of stimulus that stoked consumer demand, including the Fed's efforts at cooling inflation that helped to underpin that demand, including, of course, also the labor costs embedded into the part of the economy still growing, and locking those in. Of course, the service sector is by far the largest employer for the U.S. The rate ratio is something akin to 75-80% of employment is accounted for by services. So if ever high wages during labor shortages at the start of the unwind from COVID lockdowns were going to be seen, they were going to be seen in services with a much more significant impact than elsewhere. So we clearly see that this is where the demand is, which is why this is where the price pressure is. Price pressure and demand go hand in hand, of course. When there's demand for a particular sector's output, the prices are going to reflect that and be relatively uplifted. Not surprisingly, of course, during the COVID years, with everything on lockdown, the emphasis was on goods, not on services, because one could not partake of a lot of those services. We, of course, talk about subsequent revenge, quote-unquote, spending on things like travel and concerts and all those things that you couldn't do during the lockdowns. And so there was a kind of wedge here of gorging on goods that then kind of hit a wall. And then services really took over as the dominant engine of demand. Of course, we've talked about this and seen it in the PMIs very clearly, where manufacturing has been anemic, but services strong up until the beginning of this year. And we likewise have, of course, seen that the U.S. economy was very strong last year, but that didn't spill over to the global economy, largely because it was mainly services demand, and that's serviced by domestic firms, whereas imports are mainly on the goods side of the equation, and we can see that demand, as implied by the price impetus here, is basically flat to non-existent. And so that's what makes these numbers so interesting. The weakening part of the equation here comes from, mainly at the core, and obviously this 0.7% and this 0.3 adds up to 10, and these two cancel each other out. But the main impetus here comes from that part where growth lives. And on the good side of things, any concerns that there might have been about maybe the tariffs would create a big inflationary distortion that the Fed worried would tie up its hands, that clearly did not materialize here. At least not yet. And perhaps the reason that it didn't is what we saw in the first quarter GDP numbers, where we saw massive front-running of the tariffs with a huge surge in imports and then a parallel surge in inventories as those imports got stashed into warehouses, anticipating that tariffs would make prices go up, and so buying in excess to try to smooth out that impact as much as possible made sense. And that's perhaps why goods prices don't really reflect all of the tariff chaos that we have seen. We can see, likewise, that in the wake of these numbers, the markets actually take Fed rate cut expectations down and not up. And that's a very curious read-through for all of this and helps to explain why the dollar did what it did. Now, if you get slightly cooler inflation, 2.3 versus 2.4%, you might expect the Fed could have clearance to cut more readily. But that is not how markets interpret this. You can see, of course, at the peak chaotic period here in early April, the markets were looking for as much as 137 basis points in cuts. That has, of course, unclenched. But in the most recent days here, we've gone to just 88 basis points in cuts through the end of next year. That's a little bit more hawkish even than the Fed's own outlook, where in December and then again in March, they called for 100 basis points. Now we can see we're basically there. For this year, we have 47 basis points priced in versus the Fed's 50. For next year, 41 versus the Fed's 50. So we're very, very close. But slightly less dovish even than the Fed, this weaker CPI data doesn't do anything to change that. As a matter of fact, we're narrowly pushing out when the next rate cut is going to happen. Here's the calculus for the July meeting. We can see that whereas a week ago, a rate cut in July looked like it had better than even odds, approaching 60%, we look now and the markets don't expect that there is a rate cut that's going to happen in July. They see an over 60% probability that we don't have one. This is the current setting of policy right here. Moreover, you can see the delay in September's numbers. We got a little bit likelier chance of standstill, a little bit less of a probability of a cut as we look to September's numbers. So the markets looked at this CPI report, saw that it was a little bit weaker, and ended up saying, oh, well, this probably means the Fed can have less urgency about rate cuts because there isn't some emergency that's going on. This breakdown in April looks very much like the breakdown in March. The overall inflation rate is a little bit lower. Core is steady. There is no tariff shock here. And so the Fed need not worry. The economy is at an even keel. So there is no urgency, and perhaps we're back to normal maintenance rate cuts that the Fed intended all along for this year, well before even the calendar turned to 2025 or even before the election. Already in September, the Fed was eyeballing rate cuts this year and next year. Just because inflation expectations have fallen and it's been time to move nominal rates down in line with that, because otherwise real interest rates surge and crush the economy. So that helps to explain how, even though you got inflation a little bit weaker, Fed rate cut expectations actually moved to a less dovish setting, yet still the dollar sold off and gold found support. Because whereas the Fed's hands looked tied as they were trying to figure out what influence the tariffs were going to have, now perhaps their hands are not tied. Now perhaps they can proceed with these maintenance cuts at a leisurely pace. And that's how all of this seems to fit together. But of course, the key question here for markets that until this point were very much focused on how much panic the inflation numbers would endorse is what's actually occurring under the surface beyond that story. Because again, going back to the S&P here, we did not start this sell-off because the tariffs were hitting fever pitch. That ostensibly happened earlier. We started this sell-off because the data started to show that what is happening with the rollout of fiscal policy is creating a kind of dampening effect for consumer and business confidence, and that is hurting economic growth. And we don't know if any of these back and forth headlines over the past 4 to 6 weeks have changed any of that. The PMI numbers certainly suggest that it hasn't. We continue to look at standstill implied by business confidence numbers for April, but of course they don't capture this most recent news. We'll see how the revised S&P Global PMI numbers in their next iteration end up looking. But as it stands now, business confidence is still very much in the doldrums. And the real question then becomes, we already saw in the first quarter that the growth in consumption, which at 68.5% is by far the largest contributor to GDP, we already saw that it slowed to the weakest since the second quarter of 2023. That is, the weakest in almost 3 years, almost 2 years rather. And so with that, the question really is, are consumers paying attention to any of these headlines, or are they just ingesting that there is a lot of back and forth and a lot of noise and retrenching broadly without account for the granular details that, frankly, people like me obsess over? And we're going to find out, because later this week we are going to get a real check on where consumers are. Expectations for retail sales this week that they're going to come to a standstill in April. The year-on-year rate expected to come down to the lowest we'd seen since early 2024 at 1.1%. And consumer confidence expected to hold near the recent lows, where we got, because of expectations that what the tariffs would do is increase inflation downwind. 1-year inflation expectations in the March survey here up to a blistering 6.5%, worse than it was at the post-COVID peak. And of course, with the tariffs on China now on average 30%, and maybe coming down to the new floor of 10% if all goes well, even in that best case scenario, we're still looking at much higher tariffs. On average, a 5-fold increase versus an average tariff of 2% before any of these gains. And if consumers are not getting any happier as a function of these headlines, looking at the data, well then what we're seeing in stock markets may well just be a blow-off sentiment sweep that doesn't survive contact with what the real economy is doing. And for that, we'll ask consumers this week, see what they say. That's Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth. So come check out that conversation. It is always interesting. I'm on with Chris for Futures Power Hour Mondays and Fridays. Back with Victor and Tom for First Call Sundays. Writing for the news and insights portion of tastylive.com. And commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow.